Let's bring in Art Hogan, Chief Market Strategist with B. Riley Wealth Management. Art, welcome. I don't mean to overstrain that analogy because there are a lot of things that are different between now and then, most especially perhaps the presence at that time of something called portfolio insurance, which contributed to the unwinding of stock prices. But the things that are similar are that there was a rising market during most of 1987, as there had been up until the last month and a half or so here in 2023. And the other thing that was similar was a rapid rise in interest rates, which has certainly been the case here in this country over the past year and a half. So how far off is the idea that conditions are not totally unlike what was at hand in 1987?
Yeah, Tyler, I think it's a great question. I think it's worthy of looking into, but I certainly think it's important to remember where we were in 87, right? So coming into October 1987, the market was up 44%. It was up nearly 250% over a 3-year basis. So flash forward to today and say, okay, we're flat. The market's flat over a 2-year basis, and we're up, call it single digits on a year-to-date basis. So clearly the market hasn't sort of followed that similar pattern. We didn't have that irrational exuberance that existed in the mid-'80s, culminating in the month of September of 87. So I think that's one major difference. I think the order of magnitude that Treasury yields went up is also a major difference. So we went from 6.3 to 9.2% in Treasury yields in about 40 days, right? So the markets, when you talk about the markets largely ignoring that, the markets went up while that was happening. I would argue right now markets are in lockstep with yields. We're not ignoring what's going on in the Treasury curve. We're actually pinned to it. So for the market in August and September has looked at one thing and one thing only: what's going on in the yield on the 2-year and the 10-year, and that has driven market activity. So to me, I think the difference is almost a polar opposite. We're paying hyper attention to what's going on in the yield curve and not ignoring it very much like we did back in October of 87.
Bob, Art has just skillfully demolished my metaphor there. Would you like to pile on or add anything?
The concern that if you want to go back 40 years, the concern for the markets in the late 70s and into the early 80s was stagflation. That is, we had a weak economy and we had high inflation. I don't see that right now. The JOLTS report may give the impression we have a really strong jobs market, but at the very least, the economy is very stable right now. There might be concerns about where it's going to be 6 months, but it's stable and inflation is coming down, notwithstanding the strong JOLTS report that we saw today. So these arguments that somehow the stagflation is going to be around and come back and haunt us for a long time, I don't see that right now. I just see us repricing interest rates to where they were back before, into 20 years ago, which I don't think is necessarily a bad idea. I don't think it's a bad idea for savers to get a little bit above the real rate of inflation, which is where you're doing it right now. You're getting 5%. You're getting roughly a 2% real return. I think that's probably the way it should be. And even though I know the stock market's having a hard time adjust to that, I don't think that's necessarily a bad thing. That's much more normal historically, if you want to talk about history, than what we had in the prior 10 years.